Hey there, this is Michael with Buffalo Finances, and I'm just going to share a little bit of information here about limited liability corporations, LLCs. An LLC is a type of legal entity. It is not a tax classification. LLC is not a tax classification. There's no LLC tax treatment. It does not allow you to write things off. LLCs do not allow you to write things off. It does not lower your taxes. An LLC is a entity for legal purposes. Okay? It's used to limit the liability, right? LLC stands for limited liability company. All right. So this gets really confusing. An LLC can be treated many different ways for tax purposes. When you create your LLC, you're going to have to complete paperwork and elect how to be taxed. And there's three primary ways to be taxed when you make a selection. All right. If you do nothing, you just sign up for an LLC, and you're the sole owner, you will be taxed as a sole proprietorship. That means that the activities of your LLC, the net profit from those is going to pass through directly onto your tax return. And it'll show up on a Schedule C. It'll say, on Schedule C, on your tax return, this limited liability company is owned 100% by you, the owner. And all that profit will get taxed on your personal income tax return. And it's going to treat it like you're self-employed. Okay? Now, let's say you create that LLC and you have another owner. Let's say you're married and you have 50% owned by you and 50% owned by your spouse. Now you are a partnership. You are going to be taxed like a partnership because there's more than one owner. This entity needs to have a separate tax return. If you don't know what you're doing, you're going to end up signing up for a partnership, which is taxed on Form 1065, and you have to file that every year. I have clients that come to me every year, and they don't realize that the LLC they just created is a partnership, and they need to file a tax return for that partnership. If you don't tell your accountant that you created a partnership or how the ownership structure is, they're not going to know. There's no way for them to find out. You will get a letter in the mail from the IRS about a year after you're supposed to file this tax return, and you're going to get penalized for it. It sucks. Okay? So that's a partnership. The other way you can be taxed is as an S corp. You can make an S corp election as an LLC, and what that means is you are actually a small corporation. Small corporations also have their own tax return. It's called an 1120S. It's called an 1120S because corporations have to file an 1120, and this is an 1120S for small. Now, this is where things get really complicated. You don't want to go down this road by yourself because you'll mess everything up. S corporations are not like sole proprietors or partnerships. S corporations, I'm not going to be able to explain it very well in this video. This is too short a video. All I was doing was answering a question about LLCs. S corporations mean that they are pass-through entities, so that you are going to have to pay the taxes earned by the S corporation on your personal tax return. However, if you work in the business, you must pay yourself. Okay, you have to pay yourself, which is different than if you're in a sole proprietor or a partnership where you don't pay yourself. In those instances, you don't pay yourself. You are automatically self-employed. Any income that passes from those entities to you is going to be subject to self-employment tax. S corporations don't do that. S corporations don't do that. That's the tax selection that you can also make for an LLC. The way they work is the owner has to put themselves on payroll, okay, and you pay your payroll taxes through your payroll, which is essentially the same thing as self-employment tax. Those are both payroll taxes. Okay. Now, you pay a portion of your profits as payroll, and you have payroll taxes. The rest of it is distributed to the owner as income, and that passes through to your individual income tax return, which is listed on 1040. If all that stuff I said was really confusing, you should probably just do an LLC until you make $40,000, and then you can consider going to an S corp strategy. Okay, I don't ever recommend partnerships. They're always a mess. They always get confusing. The only reason why you'd want to do a partnership is because you really want to have someone else in control of your company. And who else are you going to have control of your company? Maybe your spouse. Um, but now you've just made it so you're a partnership for no benefit. So why would you do that? The benefit is just you trust your spouse. I wouldn't do that. So either do an LLC as 100% pass through until you make 40K a profit, then switch to an S corp. But before you switch to an S corp, you got to make sure you're making 40K a profit. You might not be doing that, especially if you have equipment or real estate or anything else that has accelerated depreciation or beneficial tax treatment. Right. Well, this was supposed to be quick. I'm gonna get going now. This is Michael with Buffalo Finances. I hope you're having a great day. God bless. We'll see you soon.